The top five price action rules. These are personally one of the ones that have worked for me as well when I started trading. So for all of you who are starting to trade or actually like scalping or day trading, these might actually work also for swing trading. So starting with Julia, what is price action? Price action is basically the movement of a security's price over time. It is considered to be the core of technical analysis and a key tool for short-term traders who look for patterns and trends to make their moves. Price action tracks a security's price movement over time, form the basis of technical analysis, and indicators like moving averages actually come from price action. The first of them, the first five rules, is actually trendline rules. Trendline connects support and resistance levels in a chart. They help identify the trend in your trading time frame. Uptrend signals, higher highs equals upward momentum, and higher lows, strong support in an uptrend. This is what you want to see whenever you're trading for an uptrend movement in the stock market. Then you get the downtrend signals, lower lows, downward momentum, and lower highs, strong resistance in a downtrend. What you want to see in the trend line rules, it's better to look at them in a higher time frame. And the trend line breaks often signal a reversal or correction and a potential new trend forming. This is what I'm basically looking into.
Sure.
So there are basically three trend lines. It's the principal, secondary, and the tertiary as well. So that's what you want to see on a trend line. It's better for you for traders who want to see with using it with longer time frames. The second one is a trading range. Basically, I think one of my favorites to use. A range bound chart has clear support and resistance levels. For me, honestly, support and resistance, those are key. A support is where buyers dominate sellers, and a resistance where sellers step in, dominating buyers. When a price breaks above resistance or below a support, a new trend could begin, and most breakout fail on the first attempt and pull back before continuing. This third point is actually key, Julia.
Hmm.
Many people want to get ahead of the first breakout trade, whether it's to the upside or downside. I will suggest personally to wait at least for a second time. This is the trading range, basically being able to put the resistance and support. You can look at it at on a 1 minute time frame to a 1 month time frame. The more you go on a higher time frame, the better off and the more powerful these trading ranges they become.
Well, they tend to be, right? Just sort of based on your experience.
Yeah, based on my experience from what I've seen, they tend to be more powerful,
Hmm.
and especially with more popular stocks. Why is this? Because what I'm seeing here, a trader overseas might also be seeing it. High probability setup rules. What is or what makes a high probability setup uh, chart? Well, a high probability setup happens when the likelihood of one outcome outweighs another, and there are four main points that you want to look up for a high probability setup. Buying dips in uptrends.
Hmm.
Right now, we're definitely in a bull market, so all of the dips being bought have actually worked. Selling rallies in a downtrend. When are you in a downtrend? When the market is in a correction, when
Hmm.
it has dropped more than 5% since its all-time highs. Failed breakouts that fall back into previous range, and extreme overbought and oversold levels that correct back towards the 20-day moving average
Hmm.
on a 1 day time frame. The 1 day time frame is that's a personal favorite to me to look into. This setup gives you a second chance to enter a trade in the direction of the main trend. This is what I was talking about prior of a false breakout. Look at how at the beginning it actually broke it out, and it was a false breakout. They tend to actually. That's why I suggest, on a personal note, to wait to a second attempt, not try to follow the trend on the first breakout. As we see here on the top is a resistance, and the bottom one is a support.
Hmm.
On the right side, the main trend, being able to follow it as well, this upward trending channel, the similar that we've been looking at right now with the market
Hmm.
overall, higher highs and higher lows. That's what you want to see for a strong movement, and the opposite when it's trading to the downside.
Nice.
The fourth one, don't fight the trend. The fourth one,
The
this is
trend is your friend until it's not.
yeah, you gotta stick with it. Yes, one of the best quotes: the trend is your friend until it's not. But one of the biggest trading mistakes is fighting the trend.
Hmm.
I've done it personally, and I can say you most of the time losses can become huge when you are in the wrong side of the trend. Be on the path of less resistance. That's key. In a bull market, think long. In a bear market, think short. If you do a contrarian trade, one of the also suggestions is keep position size small and use stop losses. That's gonna be one game changer, specifically if you're starting to trade. Do that, and you see.
That's something I can definitely get behind. So obviously, like everybody has a different basis for placing a trade. Everybody has different motivations for trading and different preferences in terms of what they like to look at, what kind of underlines, what kind of style. So I'm not gonna yuck anybody's yum. If
Yes,
technical analysis is something that you use, all power to you. But I don't think it replaces really important risk like mitigation techniques. Like sizing is always going to be very important. Stop losses, for example, if that's something that you like to use. Like, I don't think that like technical analysis or really any metrics can really replace good risk management. That comes down to, yeah, like sizing is maybe the biggest one. And then stop losses as well as something that can work. When it comes to being a contrarian or being a bull versus being a bear and sort of conforming to whatever the market is looking like, I think there's two kind of things that I'd note here, which is one, it's really hard to tell when you're in a bear market. When you're in a bull market versus a bear market, it's actually really difficult in real time to kind of like assess what the market is, if that makes sense, or what state the market's in.
yes,
So that's like, I think thing number one. And then thing number two is like statistically, bear markets just do not happen a lot. Big sell offs in the market do not happen a lot. Big downtrends in something like a diversified market index that tracks, the US economy, that does not happen very much. So this is like a big deal donut statement, like damn the contrarian in me. Totally fine to take a contrarian approach. I think again, it's down to like your style of trading, but statistically, the market really heavily trends towards bullish. And obviously, you take historical data with a grain of salt, but there's a lot of statistical evidence to support that. So I personally 100% agree. If you're taking a contrarian approach, small sizing, even more like smaller than usual, I think is very important. So I guess that's my 2 cents.
true. I felt that, especially also when you've been on the market trading for several years or months, whatever. Whenever you get to see a down movement, normally they tend to be faster and much faster and more aggressive than up movements. So that's why it's also harder to take advantage of down movements and be a bear,
Yeah.
because if they are, they happen really fast, very aggressively.
They're very fast, they're very aggressive, they do not last long.
Yes.
The risk to the upside is a lot more like death by a thousand paper cuts.
Yep.
Risk to the upside, if you're like consistently going to be a bear in a bull market, it's just like it's small, frequent losses is kind of what that looks like.
Yep.
That being said, like there's maybe like a time and a place to take a contrarian stance. So, for example, SMCI is a really good example of something that just like fucktupled in value in a really short period of time. So, like taking maybe like contrarian stance on something like that, or GME, which were a little bit more like squeeze ish. There we go. Makes a little bit more sense to take that kind of stance. But in general, for something like the S&P 500 or even the Nasdaq, I think it's a lot harder to predictively make those kinds of directional assumptions, if that makes sense.
Yes, for sure.
Borderline impossible, actually.
True. And the last point, signal candle rules. The signal candle rules confirm momentum for trade setups. Bullish candles confirm long position, bearish candles confirm short positions. Moves often start with a big candle in the direction of the trade signal, especially with larger time frames. This is key, I think, looking into larger time frames. When you want to spot a trend, start by looking to the chart on
Hmm.
a larger time frame, monthly, weekly, daily, and
Hmm.
then start running down to the 1 minute time frame. And a candle that aligns with other technical signals like moving averages or RSI can improve your success odds. And these are some of the candles, I think, the most common ones and the most sought after whenever you're looking, especially for day traders or technical analysis focused traders. Most bullish is this bullish engulfing candle.
Hmm.
Whenever you see a big one, this when you don't see any thick uh, shadow, that it's called, to the upward, downward, it's like only full green.
Hmm.
That's a very strong, the most strong of them all, especially when you see it on a daily, weekly, or a monthly. That's when might actually signal a big uptrend from what I've seen. The second most bullish, it's a shooting star as well. Big shadow to the downside, a small body to the upside.
Hmm.
Normal bullish, normal candle. Neutral bullish, a doji. They tend to be this fourth one a little bit. You don't want to normally see them because that's where they're divided sellers and buyers. And the least bullish, this inverted hammer. also signals can signal a little bit of weakness because that's where the sellers actually took place. But and similar to the bearish candles, the most bearish, the bearish engulfing candle. So look into those charts. Whoever is interested in technical analysis and also learning some stuff about candlestick basics, keep in mind these candle patterns,
Yeah.
both bearish and bullish. They're obviously way more, but these four bearish and these four bullish are the main ones to look after, specifically when you're day trading. And whenever you see them, you might actually see some follow through.
Nice.
So for the conclusion, five main points for the five rules. Well, trend lines show the path of least resistance in price movement. You want to see a clear trend line, specifically on a larger time frame. Trading ranges reward buying support and setting resistance levels until a breakout occurs. Always remember, not try to trade the first breakout on a support or on a resistance.
Mhm.
Try to wait for the second breakout. High probability setups offer second chances to enter trades with a trend. Staying with a trend minimizes risk and maximizes trading success. Signal candles confirm momentum, increasing the probability of a good trade. This is one we want to look after. And some limitations of price action, because obviously key to look into, it's subjective. Whatever a person is looking in a chart, I can look at it different ways. Time frames matter as well.
For
A
sure.
stock could be trending down in the short term, but still going up in the long run. What you see depends on the time frame you're focusing on. That's why I prefer to look into bigger time frames, because I think that gives you a clearer idea of what's happening in the asset you're looking into. And it's all speculation. Price action predictions are just that, predictions.
Thanks so much for putting this together. I'm glad. Hopefully, you guys liked it.